Okay, so welcome everyone. Today's topic is going to be the long butterfly spread, specifically the symmetrical butterfly spread. So let's begin. This is an option strategy, I think one that is a favorite among many zero DTE traders. And essentially, this combines a bull and bear spread with a fixed risk, so it's a debit strategy, and capped profits. Okay, so essentially two spreads that share the same short strike with equidistance long strikes on each side, hence symmetrical. Now, this structure can be used as a market neutral strategy, or it can be used as a directional strategy. Now, typically, my preferred approach is to structure these butterflies out of the money, which generally offers inexpensive directional exposure with a much more favorable risk-reward ratio compared to credit spreads and other debit structures. Now, in some cases, butterflies can achieve a risk-reward ratio of 1 to 10 or even 1 to 20. However, this attractive risk-reward structure of 1 to 10, 1 to 20 often comes at the expense of a lower win rate. Okay, so just like any option structure, it is a trade-off between probabilities and risk reward. Now, a little bit more on the structure of the trade. Butterflies involve either 4 calls or 4 puts with 3 different strike prices in a ratio of 1 by 2 by 1. Now, we always want to start with the 2. Okay, this is the most important. And this is essentially our short strike. Okay, so we are selling these options, and we are selling 2 of them. And this is often called the pin or the target because this is where we expect the market to go, right, as in a target, or where it may close at option expiration. Second, we need to select our wings. So we have a higher strike price, and this is where we will buy one option. And this is just called the wing because it's on one end of the spread. Okay, there's another wing, which is the lower strike price, and this is also where you will buy another option. So this creates that ratio structure of 1 by 2 by 1. Fairly straightforward. And what it comes out to look like is a profit loss curve that is like this. So you have the blue line here, which is the butterfly at option expiration, and then the dotted red line, if you can see that, is the spreads prior to expiration, and obviously that changes as the market moves and as the Greeks change. But the main thing with this strategy is that the maximum profit is realized at option expiration. If the market closes at the short strike, and that is essentially the 2. So this is the structure here, 1 by 2 by 1. And you can see here that's max profit at option expiration. Now we're going to go through a little bit of an example here just so we understand the trade before we dive into things like strike selection, trade management, and option Greeks. Okay, so I'm just going to walk through this example. I'm sure a lot of you have read this lesson. It is available within our educational material. I'm not really going to add anything new to this part. Just going to walk through the example. So what we have here is the call side of an option chain. Okay, this is for the SPX, 0 DTE. This is on interactive brokers, but an option chain is the same regardless of your broker platform. And in this example, the SPX is trading for 37.60. We can see that here, 37.60. And let's assume we have a bullish bias and we expect the market to move higher to 3,800. If that's the case, we can structure a butterfly spread around that 3,800 handle as a potential target or pin. So what we would want to do is sell to, see if I can zoom in a little bit here. what we'd want to do is sell 2 contracts at 3,800. Okay, so we are short. And what happens when you short an option? You collect a credit, right? So in this case, we would collect a credit, and then we will buy our wings. So we would buy one on the upside, one on the downside, and we will talk about strike selection here in a sec. But in this example, this is a 15 wide butterfly structured at 3,800. Okay, now when we sell the option, as we highlighted, we collect a credit. But when you buy an option, it's a debit outlay. So we will actually be paying for these long options, $37.85 and $38.15. Now, once you net everything out, it will come out to a debit. And it should always be a debit. It's always going to be a fixed risk strategy. So in this case, well, just like any option strategy that is debit, that is generally your maximum loss. So in this case, if we have a net cost of, once we net everything out, of 1.55 times 100, of course, the max loss is going to be $155. Now, there are 2 possible outcomes in which a max loss scenario is realized. And that's essentially if you close outside the wings. Okay, and in this case, let's just go back to the option structure for a sec. If the market closes below 37.85, that's max loss. If the market closes above 38.15, that's max loss. Max profit varies, right? Because it depends on your strike width. And the strike width is simply the distance between the short strike and the long strike. Now, it doesn't matter which long strike, because in this example, we are looking at a symmetrical butterfly, so the wings are equal. So what we would do here to calculate the maximum profit, now you don't really have to do this. Your brokerage platform will do this all for you. It'll tell you the max profit, the max loss, your break-even points. But it's good to know. So essentially what you're going to do is take the difference between the short strike and the long strike, in this case 15 wide, and we are just going to subtract the debit paid, which in this case is 1.55. Therefore, 13.45 is our, obviously, times 100. So $1,345 is the maximum profit. Okay, so you can see it's a very attractive risk reward, but the probabilities of actually pinning a butterfly is relatively low. So that's just something you need to bear in mind. That win rate is a lot lower, as mentioned. Now, you do have some break-even points here. Really something I don't pay attention to when I'm trading butterflies or managing the trade. Nonetheless, they're there. So essentially, in this example here, just to recap, the market is trading at 37.60. We have an upside bias for the market to test 3,800. So 3,800 is our pin, our target. It is the strike where we are selling options. So we are selling 2, and we are buying 1 long option above, in this case 38.15, 1 long option below 37.85, to enter a butterfly structure centered at 3,800. 15 wide. Okay, and we're gonna get a profit loss profile that looks like this, where the maximum profit is, what did we say, 13.45. That's best case scenario if the market closes at the short strike at option expiration, and our worst case scenario is, right, so max loss is the debit paid of 1.55, so 155. Okay, now to implement a directional butterfly strategy, you need to consider your short strike. As we highlighted, that's probably the most important part of the trade structure, because that's your target, your pin. You want it to be somewhat in the realm of possibilities. It doesn't need to be perfect, because you can still profit even if that pin does not get tested or we do not enter the profit zone. However, the maximum profit is realized at expiration, so we ideally want it to be in play at the end of the day. Okay, so you need to consider that short strike and also the passage of time. Again, because the maximum profit is realized at expiration. So not only do we have to be right in direction, somewhat right in terms of the zone the market may reach, but also the time it gets there, right? We could be too early, too late, too late or too early as in we blow past it, too late as in, the options have expired and that move ends up happening tomorrow. So we need to keep that in play, right? What, the level of volatility essentially. So two major variables, short strike as well as the passage of time. Now, in terms of selecting strikes, we have developed sort of a proprietary model for predicting pins. Trying to predict where the market is going to close is a very challenging task. Now, we found some success in predicting pins in certain types of markets, such as a positive gamma market where the market tends to exhibit mean reversion behavior, and around option expiration where the market tends to gravitate towards those big gamma strikes. But I would say overall, pin predictability is quite low. Nonetheless, we do provide 3 potential trade ideas every day within the market report. There is pin high. This is essentially our bullish idea. It will be positioned above the market price, associated with a bullish outlook. Pin low, PL, is our bearish pin idea. It will be positioned below the market price, and associated with a bearish outlook. And then we have volatility pins. So this is VP, and this is an aggressive type butterfly play, and it could be positioned on the upside, it could be positioned on the downside, but is generally associated with high volatility. With that said, it is generally positioned outside of the 1 standard deviation range for the day. So beyond that implied high metric or beyond that implied low metric. Okay, so for that to really be in play, you need to see some strong directional bias. If not, reaching that strike is generally low probability. So that is the 3 pins, pin high, pin low, and volatility pin. Now, determining what to play, should I come out and buy PH? Should I buy PL? We should continue to implement our trading process, or whether you use our trading process, which is a combination of gamma levels and cycles, or you have your own. We should simply be looking at these pins as a way to play that setup. So for example, cycle low support, you look for a pin above the market price. Cycle high resistance, you look for a pin below the market price. Really do not need to overcomplicate it. But you can kind of figure out, sometimes there's a directional bias in the market. So utilizing things like market internals, relative sector performance, the VIX, everything that we do in that morning meeting, right? Things that we go over to try to help form a bias. We can utilize those to kind of figure what pin is perhaps favorable, right? So if the market is bullish, we're uptrending, we may want to be favoring, pin high, right? Pins above the market price. Conversely, bearish, trending lower, PL, pins below the market price. So those are the 3 pin ideas. Again, pin probabilities tend to be the highest around option expiration, right? So that's monthly OPEX, as well as in a positive gamma environment. Next here, long strike. Now, this really comes down to, I think, personal preference more often than not. How wide do you want that profit zone to be? And remember, that profit zone is just the distance between the wings, right? So how big is that profit zone? And again, just like anything in trading, there is a trade-off. So if you select narrow wings, right, this is going to lower the cost of the spread, but it's also going to reduce that profit zone, right? So you're going to have a smaller target to essentially pin, right? And you can think of that from a probability perspective as well, right? You're going to have a lower probability of expiring within that zone. Whereas if you expand your wings, you create that larger profit zone, and you can say your probabilities of closing in that profit zone increase. Now with that, wider wings comes increased cost, right? You're going to pay a little bit more. So it's a trade-off. Now, generally, when there's a lot of volatility, you probably want to widen the wings out a little bit, particularly if you're trying to play for the pin, if you're trying to play for a close in that profit zone. Whereas if there is lower volatility, you can get away with a 10 wide. I wouldn't go lower than a 10 wide personally. 5 wide is very hard to profit from a 5 wide. It just does not move with much volatility, the premium. So it tends to take, you really need a 5 wide to be in play end of day to get a meaningful profit. So I really wouldn't recommend going lower than a 10 wide. 10 wide is kind of my sweet spot. I think 15 wide is quite common as well. But play around with it. I always say, even if you're not trading them, add them to your watch list. See how the spread behaves. Now let's talk about trade management. Now, I generally don't recommend using a stop on long butterfly spreads as the risk is capped, right? It's a debit strategy. So it technically has a stop built into it. So if you are utilizing full premium lost as a stop, you need to make sure you are sizing it properly. And there's a lesson on that. I'm not going to go into details on position sizing here. However, make sure you are taking appropriate risk and you're comfortable with that debit going to zero. However, if you choose to use a stop, that is completely fine. You can consider a technical stop, which would be like a stop on a break of a structure. Say you're playing like a trend line. If you break below, you can utilize that as a stop. Perhaps stops on, if you break a major gamma level or previous sessions high, previous sessions low, etc. This is very situational here on what to use for a technical stop. But that is one option. And you can also do a premium-based stop, such as I'll close at 50% premium. I really don't recommend that method. I think no stop or technical stop would probably be better. I've had so many times where I've been trading a butterfly and the thing's been like worthless end of day. Like I'm talking like 10, 20 bucks. And then all of a sudden, you get that directional move at the end of the day and it's trading for 400, 500 bucks. So I generally think no stop is the better approach more often than not. Now, in terms of targets, there's a couple different methods here when it comes to profit targets. If you are trading with the trend, of course, you can be a little bit more patient, as with any strategy, kind of let it work, etc. But oftentimes you can use the first long strike as a target or the pin. So once you've tested the pin, you can lock in some profits. So potential targets, once you're kind of entering that profit zone. Now, if you're trading counter trend, you may want to exit positions a little bit more quickly. And you can use the cycles, you can use the other gamma levels as potential exit points. So essentially utilizing the setups. Picking tops and bottoms is a very tough game to play. And I always recommend to be a little bit more defensive in your approach when playing counter trend, regardless of the option strategy. Although this approach is a very low risk way to speculate on those potential reversals. Now, you probably want to see a sizable reversal, right? So this is maybe looking for like an end of day squeeze, right? If it's clearly counter trend or sort of a midday pivot, these could be very good strategies. And matter of fact, some of my best butterfly trades occur from that midday pivot, right? Because also, you're halfway through the day. So there's much more price discovery to kind of figure out, what's the range for the day? Where can the market test? You're going to have a better sense of where the market may pin as you near option expiration, opposed to being further away, right? Such as at the market open. Now, for those that trade multiple contracts, scaling half the position, so closing half at 2 times premium, can put you in a no-lose scenario. And this often boosts the win rate, right? So for a strategy that often lacks in win rate, if you utilize this approach, you can probably increase that win rate by quite the margin. And this is something that I tend to do quite often, or at least I consider to do, to get myself essentially in a risk-free scenario. Right? And you're kind of getting the best of both worlds. You're reducing risk, right, by locking in some profit, but you're also maintaining that directional exposure to take advantage of, potentially more gains, right? And perhaps a pin if it's in play end of day. So this is definitely something I recommend. I don't know with certainty. I have to kind of filter my strategies, but I believe around an 80% win rate or so with butterflies, and I contribute this high win rate to this scaling out process here. Also, now everyone is different, so I'm chiming in here and saying what I do personally. And my philosophy when it comes to trading butterflies is perhaps different from others, but I focus more on playing the move than playing the pin. It is much easier to predict where the market is going to move in the short term, like a leg. One leg of the market is much easier to predict than where the market is going to end up at the close. Now, there are some environments, as we highlighted, that has good pinning potential where I can have some conviction to play for the pin. But my general approach is to play the move. And oftentimes, if that setup materializes, like you get a 5-minute cycle low to cycle high, 80% of the time, that's 2 times. Cycle high to cycle low, 80% of the time, that's 2 times. Right? So if you can nail one leg, you can more often than not get yourself in that risk-free scenario. Now, of course, there's times for cycles don't play out, and you'll lose. The market may just continue to go. In this case, if you're trying to play that bounce butterfly on the upside, and the market just continues, you're not going to get to that 2 times. You could lose on it for sure, but the maximum loss is the debit paid. So you don't have to really actively manage it, via stops. Or worry about it, as you would with some credit strategies. Lastly, let's touch on the option Greeks. The butterfly is quite unique, as in your exposure to the Greeks change from Well, when you're outside the wings, so outside the profit zone to inside the profit zone. So let's break down the three here: gamma, vega, theta. Now, if the butterfly spread is outside of the wings, you have a positive gamma exposure, and if you're inside the profit zone, so inside the wings, the butterfly has a negative gamma exposure. Now, the best way to think about this is if you are outside the wings, you are long the trend, right? You want the trend, particularly in your favor. When you are inside the profit zone, you are short the trend. You really don't want the market to move. Okay? Now, the thing about gamma, and for anyone who's traded butterflies, particularly end of day, that premium can be extremely volatile because gamma is the highest for at the money options and near option expiration. So this can lead to, well, significant changes in both directions, right? So remember how I was saying how I've had so many times I've had a butterfly that was trading for $20 and then end of day is trading for $400, $500 in like 30, 40 minutes. You know, you see that quick change. Okay, this is due to that gamma. Okay, so there is elevated risks trading or holding these into, you know, the end of the day option expiration. So that volatility and premium can work in both directions. Now, Vega's volatility, and this trade has a negative Vega exposure if you're inside the profit zone, and a positive Vega exposure if you're outside the wings, so outside that profit zone. Okay, in other words, volatility is beneficial if you are away from the short strike, right? So same thing, you want that trend, right? If you are positioned out of the money, right, and this is your target, you want that volatility. If price is in that profit zone, you don't want volatility, right? Because the maximum profit is realized at the short strike at option expiration. So you don't want volatility to push you outside of that profit zone. Okay, so that's probably the best way to think about it. If you're outside the wings, you want volatility, you want trend. If you are inside the wings, you don't want volatility and you don't want trend. Now, as far as theta goes, you are positive theta when the price is in the profit zone, right? So positive theta in the profit zone, theta when price is outside the profit zone, right? So in other words, think about it this way. When you are inside the profit zone, time is working in your favor. When you're outside the profit zone, time is working against you. Something we need to keep in mind here is even though this is a debit strategy, the main profit mechanism comes from theta, comes from the loss of value in those short options.